Hello and welcome back. My name is Martin Jones and this is P2 Corporate Reporting and we are in session 5. This is the second half of session 5 and as you can see we've just finished the subject of revenue. In fact, I invested a big chunk of the first hour on the subject of revenue because it is examined in every single exam without fail. Having said that, now of course I've got to tell you the examiner's only consistency is his inconsistency, and therefore I can't actually say that this is actually guaranteed, but it is highly likely. The minimum that comes up, and it's usually quite a lot more than this, but the minimum that comes up is the examiner just tells you a story. He's done some revenue recognition. He should have done over revenue recognition, and you nail him. You call him an idiot. You tell him he's wrong, but more than that, you whack him with the nowcast. You tell him that there are two forms of revenue recognition, at and over. We distinguish between them by using nowcast, and then you apply it to the scenario, and that gives you 3 marks. And that's really common as a part of a wider mix question. But you do get questions that do the other fella, which is, just let me wake this fella up, which is the unbundling, even going as far as copar. Less likely, but a really good thing to do for homework is full copar. There's dig. Can you see dig? That's your homework for this weekend, your homework from this session, your homework for this weekend. Now, can you see the 7 marks there? What I propose to do over the course of the next hour is to tell you how to answer this homework question. How to discuss. You've got all the technical knowledge you need. It's just copar, technical knowledge is copar, which is in the bag, that's sorted. But how do you communicate using this implement, using the pen? Your other homework question is Rockby. Look at that baby, also 7 marks. 7 marks is really common for a mix mini scenario in question 2 or 3. And again, the active word discuss. I'm going to teach you held for sale and discontinued operations. This question, Rockby, is on the basis of held for sale and discontinued operations. I'm going to teach you held for sale and discontinued operations, but you're going to do question Rockby as your homework. But how are you going to answer Rockby? How are you going to answer this discussion? Well, I'm going to teach you how to answer the earlier questions by actually answering this question, oil rig. That's where we're ending today. Now, oil rig, as you can see from the top there, is on the subject of provisions. Now, provisions is a relatively simple subject, and because it's a simple technical subject, we can actually spend the majority of our effort when doing oil rig not looking at the provisions, but actually looking at the discussion and how to score 7 marks. So I'm going to show you how to answer in the B section by doing question oil rig. Now what you'll actually find is when I do question oil rig, the style of answer that I use is exactly the same as the style of answer that I used right at the end of the last session when I did question value. It's heading sentence, heading sentence, heading sentence, heading sentence. That's the way you communicate. Heading sentence, heading sentence, heading sentence. 65 marks of narrative, therefore 65 headings with 65 narrative sentences underneath. That's how you do the 65 marks of narrative in P2. But I'm not just going to tell you that as a theoretical idea, I'm actually going to do oil rig. But before I get there, I'm going to work my way through what remains in between. So we've finished revenue. There's the end of revenue. There's the question dig, which is homework. We're now going to do held for sale and discontinued operations. Now these are kind of 2 separate subjects jammed together in one IFRS. So I think I'm going to use the pen. I haven't actually opened up the pen so far. So I'm going to use the pen now for a little bit of variety. NCA, HFS, moves to CA. Look at all those abbreviations, boys and girls. NCA, non-current assets. HFS, held for sale, of course, moves to CA, current assets. Plant held for sale is held for sale and therefore is not a non-current asset. What is not a non-current asset? Not a non-current asset is a current asset. So if you have a non-current asset, you have a current asset and you move it out of non-current assets into current assets, and that's what happens. But this only happens if you fulfill criteria. And the criteria are the sale criteria. Very cutely. And you must fulfill all the criteria, S and A and L and E. So it's sell, available, locate, and expected. For a non-current asset to be classified as HFS, is to be classified as held for sale, then there must be a clear intent to sell. At the measurement point. The asset must be available to sell in its immediate sale, in its current condition, ready to go. So the asset must be ready to go. Locate is a bit of a mouthful, but that is the phrase that's used in the IFRS. You must be actively seeking to locate a potential purchaser. So actively looking to locate a buyer. Looking for a buyer would be an easier way of saying it, wouldn't it? But that's not the phrase that's used in the IFRS. The IFRS refers to locate. So let's use the IFRS language. And expected is the sale expected to be complete within 12 months. Very, very simple. If you think an item in PPE is held for sale, is HFS, then you test it for the sale criteria. If it fulfills all four, then it is held for sale and it moves. And if it fails any criteria, then it stays still. So you look in your PPE, if anything looks like it's HFS, you test it. If it is HFS, you move it. And by the way, what you call plant held for sale is plant held for sale. And you just whack it somewhere in current assets. There isn't a particular place. Most people tend to stick it at the top of current assets, which is above the stock, above the inventory. But you know, stick it anywhere you like. There's no rules there. So the HFS, you can probably guess this is frequently examined where someone already has treated the asset as HFS, but when you reperform their test, they fail one of the criteria and you reverse the classification. So usually lots of these subjects are examined as fails. So in the scenario, the examiner has already classified the asset as HFS and you say, no, you're wrong. It fails S. There's no intent to sell. Therefore, the asset moves back up into PPE. So you just put it back into non-current assets. That's it. Simple little subject. closely related to but separate from discontinued operations. An operation is classified as discontinued if it is closed or sold or HFS at year end. And of course, to test an operation for HFS, you use the sale criteria. If plant is classified as HFS, you call it HFS plant. Plant HFS. If property is classified as HFS, you call it property HFS. But if a subsidiary is classified as HFS, you call it discontinued. It's not wrong to call a subsidiary that's held for sale subsidiary held for sale. It isn't wrong, but it isn't the right language either. It's not the proper language. The proper language for a subsidiary held for sale is discontinued. And the presentation of this discontinued operation looks like this on the P&L. Which gives me a chance to go back to something that I skipped earlier, deliberately skipped earlier. If you have a discontinued subsidiary during the year, goodness me. If you have a discontinued subsidiary during the year, then it's quite nice actually if I sort of expand this and give you a little more flavour of it. So let's do it this way around. So Thumb is the parent, and Thumb has 4 subsidiaries, 1, 2, 3, and 4. And 4 is discontinued during the year. So it's sold right in the middle of the year. So it does actually have 6 months of sales that are under the control of the group. So it is part of the group for 6 months, and the P&L is of course over 12 months. So it'd be natural to consolidate the sales of all 5 entities, you know, just add across, as you would usually. But you don't do that. If you have a discontinued subsidiary in the way that I've just described, what you do is you hide the subsidiary from the, well, yeah, that's hard to do, from the operating, and you just consolidate the parent and the 3 continuing subs, as they're called. What you do is you take the discontinued sub and you shunt just its pat at the bottom. Okay? So yes, if you have a discontinued subsidiary, you shove its pat at the bottom. That's what you do. But hang on, wait a second. What's this thing called a super exceptional? What's going on there? We'll say Thumb for the sake of let's have some industries here. So we're going to have IT, teaching, retail, cars, and forestry. Okay, so we discontinue forestry, right? We discontinue forestry. But also during the year, there is a massive, massive fire that destroys one of the car factories. All right, so in the continuing business, there's big, bad news. I apologise, my head keeps on getting chopped off here. I think we've got the camera position slightly wrong, but I'll try and stay in as much as I can. So what you do with the discontinued sub is you whack it down in discontinued. But any big bad news that happens in the continuing business goes on a separate line called super exceptionals. Now, super exceptionals doesn't have any fancy definition. So anything that you feel like putting into super exceptionals, you can do. And you'll see the examiner using super exceptionals occasionally on the revision course, and I'll be referring to them occasionally on the revision course. So this is just an excuse to mention the thing now. But there is something very important about super exceptionals. Is what you do is when you have a super exceptional on the face of the P&L, you don't call it super exceptional. You call it by a more useful phrase. You call it by what it is. So if you have a super exceptional fire, you don't call it super exceptional. You call it fire. If you have a super exceptional tsunami, you don't call it super exceptional, you call it tsunami. If you have a super exceptional alien attack, you call it alien attack. So you use the phrase of whatever it is, okay? And the definition of super exceptional is just big or unusual. It's usually and, but the definition is actually big or unusual. Okay, so if an operation is classified as discontinued, then you slot it in at the bottom. Under what circumstances could it be classified as discontinued? If it is one of these three, if the operation is closed or sold or HFS, one of those three. Punnett has a very strange question, which I will entertain on this occasion. The question is, why does HFS, sorry, I do apologise, why does NCA HFS move to CA and not to NCA? I think you've really fundamentally misunderstood what I'm saying here. So HFS is a test that we do on the NCA. So if there's something in NCA that's HFS, we test it for HFS, and if it is HFS, it's HFS, it's held for sale. And anything that's held for sale is held for sale. You know, things that are held for sale are held for sale. They're not held for manufacturing, they're not held for the accounting department, they're not held for continuing use, they're held for sale. And when things are held for sale, then they are current assets. But you can't just move plant because you feel like it, because it feels like held for sale. You actually have to test for held for sale. So if you've got plant that looks like it's held for sale, then you test it for S, for A, for L, and for E. And what you might find is you fulfill three of the criteria, and it does feel like held for sale, but actually the intent was to keep the assets at the year end, and therefore it fails the S criteria, therefore it doesn't move. So that would be the most common. The examiner's favourite is, you know, the intent at the year end is to keep the asset, and therefore it fails the criteria. That's his favourite. He loves the S. So what you do is you look in NCA, and if there's an asset in NCA that looks like it might be held for sale, you test it for held for sale. What the examiner often does is he's already moved the asset. Then he tells you the circumstances, and you tell him, no, it's wrong, move it back. All right? Very odd. Seem to be making quite a big meal of this. How am I doing for time? I probably better not spend any longer on that. I think you have the idea. Go and have a look at the video again. Right, so what I promised you was looking at segments and provisions. Now, as promised, what I really want to do is I want to do this question on oil rig. And I really do want to do this question on oil rig. So I think the sensible thing would be to skip segments for now and make sure that I pick it up next time. Maybe we'll go quite quick with the question oil rig, but maybe not. So I'm just going to have a go at question oil rig, see where we are at 4 o'clock. 4 o'clock, do I mean that? 5 o'clock. See where we are at 5 o'clock, see if we're just before, just after. And if we can go back to segments, I will. If not, we'll pick it up next time. But what I want to do is the technical component of provisions. So we'll skip to provisions now. So provisions are recognised if you spot the rot. If you have a reliable estimate, that's a bit too small for me. If you have a reliable estimate, an obligation and a probable outflow. Now, if you don't fancy spot the rot, you can go for spot the rue, which is, let's have a look at spot the rue, see if you prefer that. I think I'm sort of leaning towards spot the rue. G'day, g'day, R-O-O, spot the rue, g'day. Good day, cobber. That's what I'm thinking about. Is that an Australian accent? I don't know. And you can see there are 3 criteria, and you know, part of the question oil rig involves us applying the criteria. But can you see the 7 marks? So what we need is we need to make 7 points, and that's the idea. Now, the first thing that we're going to do is we're going to learn how to communicate. The way to communicate when doing a discussion is you use heading, sentence, sentence, heading, sentence, sentence, heading, sentence, sentence. In fact, that's one of 3 ways to communicate. There are actually 3 ways to communicate, one of which is heading, sentence, sentence. But with a question like this, as you can see, there are numbers. Sometimes you talk about the numbers. It's still a discussion, but you talk about the numbers. So it's heading, sentence, numbers. But this is an accounting exam. So sometimes you find it useful to use heading, sentence, journal. The 3 ways to communicate are heading, sentence, sentence, heading, sentence, numbers, heading, sentence, journal. Okay? And that's what I'll use on oil rig. First of all, I'll whack down the criteria, then I'll apply it to the scenario, and then I'll build my answer from there. First of all, I'll whack down the criteria. Spot the rue, g'day. First of all, I'll whack down the criteria, then apply it to the scenario, and then I'll build my answer from there, using heading, sentence, sentence, heading, sentence, numbers, heading, sentence, journal. Here we go. So I need black here, provisions. So I will be teaching you how to account for provisions, but the main focus for the next half hour will be on how to communicate. And I'll teach you this by doing the question oil rig. First thing you do is just whack down the knowledge, you whack down the criteria. There are 3 criteria. Spot the rot, or if you prefer, spot the rue. G'day. So it's reliable estimate, an obligation, and a probable outflow. And it's probably worth translating these technical phrases at least a little. So reliable estimate really just means any reasonable guess. Obligation is a legal or constructive duty. I don't know if I've left myself enough space there. Do you mind if I just move that equals? Because I've definitely got enough space if I move it over here. Legal or constructive duty. My wife has promised me that she's going to pick up my son from his after school club. I don't think I could actually sue her if she didn't. But she said she's going to do it, so she has to do it. She has what's called a constructive duty. So a constructive duty is a duty that you have because of what you've said you're going to do. I think a legal duty is fairly obvious. It's a duty you have because it's the law. An outflow is a probable outflow, more likely than not. What's another word for outflow? Probable flow outwards. Yeah, there you go. So now we'll apply the criteria to the scenario. Now, I have to be honest with you. You've got a great advantage here. At the top of the page, it tells you that the subject is provisions. So we know that we're trying to apply the spot the rot to the criteria. It's much harder in the exam because in the exam, you just have what's over my shoulder and you don't have the title at the top of the page. So part of the skill is working out what the subject matter is. That's definitely part of the skill. But part of the skill is also the written communication. So let's get into that. A company starts using an oil rig at a cost as follows. Construction 200, installation 100. The oil starts pumping at the year end. At this point, the company sign a license with the government agreeing to dismantle the rig when the oil runs out, which is estimated to be 20 years. The cost of dismantling the rig is estimated at 120 and the discount rate is 10%. I'm sorry, the discount rate is 10%. 120 million, 100 million and 200 million. And we're going to test one of these numbers for spot the rot. Which one is a potential provision? Of course, it's the 120. We're not going to provide for the other two because we've already paid them. But we haven't paid the 120. Maybe we'll provide, maybe we won't, if we spot the rot, if we spot the brew. So let's now apply the knowledge to the scenario. This applies to the 120 million as follows. The oil company already have an estimate of 120 million. The oil company have an estimate of 120 million. The license gives a legal obligation. Outflow. The dismantling will cause an outflow, you know. The engineers will need paying. Obviously money will flow out. When we pull down the oil rig, the engineers aren't going to do it for free. So we fulfilled the criteria, spot the rot or spot the root. So the conclusion is that we're going to provide. So the oil company must provide. And the amount that they provide will be the provision. But hang on. The 120 million is going to flow out in 20 years' time, is estimated to flow out in 20 years' time, is estimated to flow out in 20 years' time. And we need to therefore discount it down to its present value, or discount it down to the fair value, as we accountants tend to call it. And what we need to use is a little bit of maths called discounting. So we divide by 1.10 to the power of 20, which is a bit of a shock to anyone who's not expecting any mathsy type stuff. Of course, it's financial management. We have our financial management superstar in the studio just next to me, just there. And he will tell you that this is the process of discounting. Just to tell you where the information's coming from, the 10% gives us the 10, and the 20 years gives us the 20. Can you give me that number? Are you able to do that? Is your maths up to that? Can you do that on your calculator? If not, you might need to do a little bit of financial management and do a little bit of checking out on YouTube. Because unlike in financial management, they don't give you any extra guidance here. You just have to be able to use your calculator. There's different ways of doing it. I'll talk through the way that I'm going to do it, but you use whichever works best for you. So 1.1, I have to do it this way around. So there's all sorts of different ways of doing it. 1.1 raised to the power of 20. Where's raised to the power of 20? X to the y, there we go, 20 equals, I get 6.7, and then I flip it, so I use the reciprocal. So what that's telling me is 0.1486 or 0.15 basically. That's telling me that each dollar in the future is worth 14.5 cents now. So yeah, and then we multiply that by each individual dollar, which is what, 120, and we get 17.83, or as Ridwan says, oh hello Ridwan, you've been very quiet, or as Ridwan says, 18 million. All sorts of different ways of working it. I'll just do it. The way I'm doing it is a little bit slow, but it might work for those who are not particularly good with calculators. What I do is I put in 1.1, I then raise it x to the y, I raise it to the power of 20, that gives me 6.7. I then flip it using the reciprocal sign, which is 1 over x. That gives me 0.1486, which is the number of cents that each dollar is worth. Then I multiply by each dollar, which is 120 million of them, and I get $18 million. That gets you 3 marks. No, not the 18 million, the whole answer so far. You've just failed. Ah! And we keep going. But how are we going to recognize this? The above is recognized as follows. Obviously, we're going to have a credit for the liability, for the provision of 18 million. But the other side of the double entry, the debit, is the cost. But what we want is we want to get the cost into 20 different P&Ls. And the way to get that 18 into 20 P&Ls is to depreciate it. But you can't depreciate unless you first capitalize. So we must capitalize this. And that's another mark. And then there's another mark for explaining the depreciation. Oh, and I tell you what, there's more. There's another mark as well for explaining that 18 is not in isolation. It's part of the oil rig construction cost. The above PPE cost is capitalized with the other costs. What other costs? Well, we use heading sentence numbers to communicate now. Construction was 200. Installation was 100. And dismantling, cost of the dismantling was 18. And that gives 318 as the oil rig cost. There's another mark. See how we're building? And then the next mark is for explaining the depreciation of that. Then the above depreciates over 20 years. That's the 318. Why don't you use a journal to explain it? So we'll have a debit going to operating costs, and a credit making the carrying value of the PPE go down. And of course the figure that we require would be, how should I do that? 318 divided by 20 years. 318 divided by 20 years. So 318 divided by 20 years. 15.9. Oops. 15.9, 15.9, and it's a rather cute little detail that actually 0.9 there, that 0.9 is the 18 being divided by 20 years. You don't really notice the individual dismantling depreciation charge within the total oil rig cost, but still, you know, the oil rig has got dismantling costs and 0.9 of it is related to dismantling costs. So that's going to go to the P&L, but it's not the only cost that's going to go to the P&L. Let's put balance sheet there as well, just to put that in. The really important point is that there isn't just one 18, there are two 18s. They're both 18, but they are different. There are two 18s. We've already talked about this 18. It gets capitalized and then it depreciates down to 0. That 18 we've dealt with, but this 18 goes up. It starts at 18 and it grows and grows and grows. It snowballs. It grows exponentially. It compounds. It unwinds. Because of course that 18 is the present value of 120 million in 20 years time. And eventually that 120 million is going to need to be paid, and the liability gets bigger and bigger as you go towards it. And that process is known as unwinding. Unwinding. Quite separately, the liability unwinds. Here is the first year journal. So we want the liability to go up, so we want the provision to get bigger each year. And the way we do that is by adding 10% to the 18. So we discounted down by 10%, so we unwind back up again by 10%. You always, always, always unwind at the rate that you did discount, always. And this unwinding, this compounding, is very close to interest. It's not quite the same as interest, but very, very similar. So it goes into financing costs. Now the depreciation journal happens every year, and the unwinding journal happens every year. But the depreciation journal is constant, it doesn't change. What was the figure? 15.9 is constant, 15.9, 15.9, 15.9, and the asset just goes down, 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 in a straight line as it's called. But this 1.8 compounds, it grows. And this process can be described in what is called the unwinding table. Here are the 20 years. Here are the 20 years. A very nice table. And some of you might recognize this. So the years here, the opening balance, interest then accrues at the discount rate of 10%, and then the instalment is paid each year to give us the closing balance at the year end. Start at the beginning of year 1 with an opening 18, and then we add 1.8. The amount of cash that we pay to pull down the rig at the first year end is 0 because we don't pay anything, giving us 19.8. And we wrap that around, so that's 19.8, gives us 1.98. And therefore 21.78, and then year 21.78 gives 2.178, etc., etc. I'm not really going to go to the 20th year. Oh no, I will go to the 20th year in the sense that I'll put in, when you get to the end here, you get to 120. There'll be a rounding error, of course, because we use pretty brutal rounding with our 18. But it'll be around about that figure, 120. And of course, if you're really exact about this, you'll get an exact figure. And that's how to answer it. But look at the size of that answer. I'm pretty used to these questions now, so your hand's probably hurting. You're probably not used to writing that fast, to be honest with you. Look at how big that answer is. That's the size of answer that you want. And often students, especially taking the exam for the first time, they just have no idea how much they're supposed to do. They just do spot the rot and, yeah, you know, I just scored 7 out of 7. But take a look, actually. I'm hoping, I tried to deliberately make a mistake. I was working at full tilt, so I don't know if I've succeeded, but I was trying to make a mistake. 1, 2, 3. 4, 5, 6, 7, 8. That's how a marker marks. A marker just goes, that's right, yeah, that's right, that's right. And they just give you ticks and they don't really think about it. And then they try and allocate the ticks to the marks and the machine says, no, 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 no. That's too many marks, and they have to pull one off. It doesn't actually tell you how many too many. So they'll pull one off and then they allocate again, and you get 7 out of 7. So actually the point at which I scored 7 out of 7 is this point here, just before the unwinding table. I'm not too keen with that particular pink. Pink is horrible enough as it is, but let's do it this way. So it looks more like a line. There we go, that's better. So the point at which I've scored my full 7 out of 7 is, as you can see, just when I finish with the last journal. Now that's entirely appropriate, because if you go back to the question, can you see that it wasn't just asking us to discuss? It was the most important word, and yeah, sure enough, it was asking us to discuss, but it was asking us to do the current year and therefore not next year. And what I did, of course, was rolled on to next year and the year after, didn't I? And that's why I'm not scoring marks there. I've gone too far. But the size of the answer, can you see the size of the answer tends to take students by surprise. They tend to just not write enough. You know, the examiner complains about it constantly. Students answer the question correctly, but they only make 1 point for a 7 marker. And, you know, they just come straight to the point too quick. They say, revenue should be this. There you go. It's like, yes, that's right. You can have your mark for that. But what about the nowcast? And what about the basis? And what about the knowledge? And what about the at and the over? And there just isn't enough individual points. So when you're delivering your answer to question dig, I want you to use this style that you've just seen over my shoulder. Let me show you again. I want you to use this style that you can see over my shoulder whizzing past you there. That's what I'm looking for. So heading, sentence, sentence, heading, sentence, journal, heading, sentence, and numbers. Heading, sentence, sentence, heading, sentence, numbers, heading, sentence, journal. That's the way to communicate. Sentence, sentence, sentence. It's a discussion, not just the numbers. So there you go. That was me scoring 7 out of 7. And it's pretty tricky. And we'll be doing lots and lots of this on revision. Every single question we'll be using that formula. We won't change at all. That formula is a constant. And that is pretty much time, but there's actually 5 minutes available, which is probably just enough to go back and have a look at that thing that we skipped. It's a small little subject, but if we can do it in 5 or 7 minutes, I would like to. So let's go back and have a look at the subject that we skipped. So if I can roll on, contingencies, that's where we'll pick up. So contingencies is in the program to be done next time I see you. So we'll pick up with that. But here and now, I want to roll back and have a look at segmental reporting. So segmental reporting is the idea of dividing the business down into its business units. And if you have a business that makes more than one product or sells in more than one country, then you need a segmental report breaking down between the products and breaking down between the countries. You tend to get in the exam just either multiple products or multiple countries. You don't tend to get both. But this is actually multiple products in multiple countries, just to make sure you've got the idea. So when I say this, I mean question Kipling. So we're going to learn how to do a segmental report by doing question Kipling. All you do is divide the business down between the different products. So this is a product segmental report. And what are the 2 products? Let me just remind myself. Professional and higher education. So I take the total and I split it between professional and higher education. And I don't split all the figures. It's a note, you see. I don't split all the figures. I just split revenue, operating profits, and net assets. I just split the 700, 200 and 500. It's just a note. And all I do is just use the percentages as given in the question, which is 50-50, 30-70, and 30-70. And it's a little bit naff to do the other as well, but why not? If you have a business that operates in multiple nations, in multiple countries, then you do a geographic. You split on the basis of geography. You take the same totals, for revenue, operating profit and net assets. And you split between the relevant countries. In this case, it's US and UK. And that's all segmental reporting is. So 80-20. Uh, 50-50. And 70-30. Yep, there we go. That's it. That's segmental reporting. And, you know, simple questions that just ask for simple segmental reporting like that do come up occasionally. But actually, the most frequently examined component of segmental reporting is trying to work out what headings to put at the top of our columns. What do you mean, Martin? We work in the US and the UK. Obviously, we're going to use the US and the UK. It's completely obvious what to do. Why do I need any guidance on that? Well, you don't when you work in just the US and the UK. But if you're Starbucks and you work in 180 countries, it's a bit mad to have 180 columns. So what we need is a concept called aggregation, which is bringing stuff together. What we need is a concept called reportable segments, which is aggregation, which is bringing stuff together. And there are two guidelines on aggregation, and that's where we're going to end. So the technical thing is not so much actually the numbers, but deciding on how to name our columns. And there are two guidelines that you have to learn. And you know, segmental reporting is not that commonly examined, but when it is, it's these two that get examined: the 10% guideline and the 75% guideline. 10% guideline is really simple. If any segment has greater than 10% of the whole business, then it should have its own business. And the 10% is usually applied to sales, although it could be various figures. So if any part of the business has got more than 10% of the whole sales, then that segment should have its own column in the segmental report. But there's another guideline as well, which is a bit weird the way it's written, but if we translate it, it works okay. Also, at least 75% of the whole group must be reported, and that's very hard to read. What this means is other segments should be kept to a minimum and certainly less than a maximum of 25%. So what you can have is US, UK and other, but the maximum you can have under other would be 25%. And therefore 20% under other countries would be fine. But the examiner doesn't do that. When he examines the 75% guideline, when he examines the 25% guideline, when he examines this idea of other, he has some stupid number under other, like half the sales, 50%. So what you do is, you get the story, you get the idea, don't you? A lot of these scenarios are based on the examiner being a bit of an idiot, really, deliberately being an idiot and asking you to criticise him. So he puts half the sales under other, and you say, no, that's a breach of the 75% guideline. The 75% guideline says at least 75% of the whole group must be reported. That means a maximum of 25% can go under other, so you need to reduce the amount that's in other, would be the advice that you would give. Great. So that's segmental reporting. The two guidelines, commit them to memory. Thank you very much for your patience. Perfect timing, I think, to be honest with you. I'm just going to slip off to the slideshow. Why does it say outrageous as being homework? That's not the homework. My apologies, guys. I don't seem to have picked up on that little detail there. The homework is not the question outrageous. My apologies. The question dig is homework, and also the question Rockby, particularly the question dig. Now, what I want you to do is I want you to have a try at question dig using the way of communicating that I was using for the question oil rig. Actually getting the answer is not that difficult, but getting the answer and scoring the 7 marks, not so easy. Of course, you have my answer in the back of the class notes, but also I'd like to see your answer. So whack it on a piece of paper, take a photograph, PDF it, send it across to me, and I will give you a mark out of 7. Question dig is homework. I look forward to seeing you on Thursday. Have a fabulous couple of days. I'll see you on Thursday.